for those who cannot get here. And it's Rhythm and Price webinar number 435. Thursday, the 5th of May, 2022. Usual terms, conditions, disclaimers, and warnings apply. It's not financial advice. I'm not a financial advisor. Where advice or advisor are protected legal terms, in any respect, I make no claim to the use thereof. It is, however, for discussion, for education, and for cross-fertilization of ideas based on experience and observations of the markets to my and all of our ability. I think I'll put in remind everyone of the disclaimer I normally add, which is more against that my personal opinion about the state of the markets is such that the potential volatility contained within markets at the moment, it greatly exceeds most professional estimates or historical estimates of what the actual conditions imply, unless those measures of historical conditions reach back a minimum of 42 years and preferably 84 years, because they're the size of cycles that we're in at the moment. And in 1929 to 1932, the stock market declined in the space of 3 years, 95%. In the 1970s, about 42 years ago, it declined, I think it was about 50%. In 1987, it declined 38%, and all declines since then up to 2009 were smaller. It is my humble opinion that the potential for large moves has increased again and will only be realized as it is seen. Now, I give an example of gatekeeping rules in markets being applied. In 1980, the silver market changed its rules in such a way that the Hunt brothers were broken as they were applying a corner of silver by taking physical delivery of the actual metal, by purchasing futures and insisting on delivery, all of which is quite legal. Subsequently, the rules were changed. Of course, the establishment traders were short, the Hunt brothers were long, and as the price rose, pressure was exerted. The newspapers were co-opted into the game and joined in, and the Hunt brothers were decried as being hoarders and manipulators, which they were in a way. But if the market had a propensity to go up, what were the people that were shorting it doing? So anyway, the upshot was that the market changed its rules in such a way as to only allow new trades to be opened if there were closing positions. That meant the market was closed and was locked except for unwinding of the positions. The Hunt brothers essentially lost their fortune and were dragged through the courts. Now, lest you think that that is a one-off, this year, the LME in London closed when the price of nickel broke out. Instead of just breaking out in a calm way, it went vertical because, once again, the insiders were all short and were scrambling to cover. So what did the LME do? Instead of insisting upon delivery and giving the profits to the people who had purchased the nickel, the LME shut down, closed, gatekept, and cancelled trades and unwound the trades to the day before. I think they go back to the morning. Maybe it was just the morning of that day. But the bottom line is they cancelled legal contracts. Later on, we are told that the people who were short were members of the LME who also were making markets in other metals, and therefore their continued viability was important to the structure of the market. We are told. Do I believe any of that? No, I don't believe anything these people tell me, but I'm just telling you that potential for volatility from a 90% decline in 3 years to a 50% decline to a 40% decline in flash crash type movements. What is the volatility when the insiders close the market because you're on the winning side? And they reopen it when your profits are gone. What's that volatility called? They call it circuit breakers. So just be aware. That's why, I'm using the word volatility to contain rules and rule changes which are designed to protect the market and its participants from you if you're on the right side of a good trade. Because all it takes is enough other people to be on the right side of that trade, and they're pulling the trapdoor and the noose is already around your neck. So let's take that disclaimer off the board, because it's about time I reminded. Let's see. It's funny about that. Okay, I think that's gone. And which to go first? A couple of points on geopolitics. The US Supreme Court leaked that Roe versus Wade may/will be undone. Instantly, the woke left, feminists are in uproar and are motivated to protest to try and stop this, stop the evil Republicans, the white man, I don't know, whatever way they've been taught to think about it, they're thinking about it that way. This is a divisive issue being teed up and inserted prior to the midterm elections in the United States. They have reached back. I'm curious to know how many years they reach back. Let's just look it up. And they just dragged up a dead issue and they put it in the news. And what are they doing? They're creating partisan politics so that the people who think that Joe Biden is a total disaster feel motivated tribalistically so as not to shift over to the other side. I suppose it's reasonable to expect more of the same. What are we talking about here? The phrase shit stirring or incitement to riot. No, it's not quite that, but slightly below that level. There will be riots. But make no bones about it. This is coming from the left. Now, the other big thing that's geopolitical is that Musk has taken over Twitter, and the possibility of the left not having total domination of social media space prior to an election has essentially caused the veil to be ripped off completely. And things are being said in the media which basically describe exactly how Twitter was used. What they're doing is they're saying the Republicans can do this, do that, do the other, and they're describing all the things they've been doing in Twitter. So all I say is it is what it is. Meanwhile, however, Musk has set himself up as if this works out positively for the people on the right of American politics. Musk has set himself up for a presidential candidacy in the following election. There's an if at the start of that statement. Now, that's not to say Musk has to play it that way, but I would presume that that's one of the scenarios that he has in his little book of scenarios as to how this may work out. What else? Okay, another thing I hear speaking about bonds. I hear people talking about the fact that the Fed will not be able to raise interest rates, and the Fed will raise interest rates, and inflation needs to be choked off, and The Fed can do this, can do that. And this is one of those weeks where this is all considered very important. Let's be clear on this. The size of the bond market right now is staggering. If interest rates rise beyond a certain point, all taxation revenues to governments in the West will be completely absorbed by maintenance interest payments on their national debts. The only thing that works against that is that their central banks have printed so much money that a lot of the national debt is owned by the governments themselves. This is not being talked about. For instance, the Bank of Japan owns 50% or more of the Japanese bond market. So if interest rates rise in Japan, and Japan has a staggering national debt, what is it? Is it 300% debt to GDP? Is it? Oh, it's ridiculous. It might be 250%, but it's totally unsustainable. And somewhere over about 120, 130% is where you get revolutions when it works its way out. Anyway, Bank of Japan owns so much of its own bonds that when the interest rates rise, they're paying the money to themselves. Half of it just goes around in a circle. That's not been taken into account in the people who are saying interest rates can't rise. Or the other point I would draw to your attention is that anyone that talks about interest rates going to 15%, such as Paul Volcker did in 1980 to protect the dollar when it was collapsing and stop the rise of gold, that was the top of the interest rate cycle back then. This is the bottom of the interest rate cycle now. If you want to talk about interest rates going to 15% and staying there, you need to look forward 25 or 30 years. But we are due for a lot of churning, and that churning could be short and sharp and very troublesome, and it would have a rate of change that should be absent from AAA bond markets. So the risk of bond markets is extreme, but it's not as being portrayed by some people in the financial media. It's short-term high interest rates might be a problem. Long-term high interest rates are coming, but in the long term. I just wanted to make that clear. That's my interpretation of that. Now, let's see. Let's look at Tapatalk. So let me just call up the screen here and show it here.
So in your view, how screwed is Europe in that sense? Because I have no idea to what extent.
Oh, we're all screwed.
Does Europe owe itself, or does it owe mostly external creditors? I have no idea.
Look, I don't believe anything. I mean, they've got fraudulent records. They've made it legal for banks to have fraudulent records. I don't believe anything anyone says. How screwed are we? We are screwed to the extent that our ability to stop our governments doing what they want to do has been infringed to the point where our governments are doing what they want to do. We've just been under house arrest for 2 years. Kind of. So, like, you know, when you're living in a prison and it's an open prison, just be understanding that the guards can sort of tell you what you're going to do next. So, how screwed are we? We're looking at, I mean, was it 2 years ago that I showed a chart with 80 years of stagflation on it? Do you remember that chart?
With 80 years of stagflation?
Well, an 80-year cycle, 40 years this way, 40 years that way.
I'm not sure. Yeah, probably if I see it, but
I didn't think you did. You know, like, so, you know, all this talk about technology. Well, technology is one thing and humans are another thing. And the assumption is that technology can produce astounding wealth and savings and all of that in the future. There's a peak to the effect that everything has. And we could be coming to a period where new technology brings very small additional benefits. I'm not saying we're there because it's an unknown, but I'm thinking in terms of the open check that leaders and the military believe that technology is going to write to enable them to spend. It might not be as good a check as they think. It might bounce when it comes to be presented. We need to just look at how practical developments really are. You know, like, I don't know, I mean, they talk about quantum computing. It's incredible what quantum computing can do. Well, it takes a nanosecond to do what takes in a second and a quarter. That's really going to make a lot of difference. Now, I know that they'll say it make a lot of difference. I don't know. It's not the difference. It's the percentage change of the difference. You know, if you have an automobile that goes at 100 miles an hour and it gets to 101 miles an hour, that's a new record. But did it make a lot of difference? There comes a point at which the added costs begin to exceed the benefits. And we were talking about sensors in cars and safety features in cars before we got started, which disable the cars essentially from being used as they're capable to be used. I just think a wider look at complexity of society versus fragility of society needs to be taken into account. And I'm going to show a gigantic wild card in a few minutes on the natural cycles. As I've always proposed, that when the big cycles come in on the currencies, they're going to come in nature as well.
Can I drop one thing in there real quick?
Yeah.
All right. So one of the hypotheses that I'm still kind of really bullish on is that data is the new currency in the future, because that's essentially the only infinitely renewable resource in this whatever kind of monolithic world we're going into. So if that's true, let's just go with that for a second. And people who are boomers start getting sick. There's three kinds of medicine doctors practice. One is tried and true for 20 or 30 years. The next is kind of like, we just discovered this and it's been up for a couple of years and, you know, it's moderately new. And then there's the super high end, which is completely experimental, which essentially professional athletes and colleges are working on right now. And this is going from someone I know who's worked in biotech. So let's say the boomers get sick. Demand's been created because of new therapies and technologies that were introduced in the last 2 years. If you're going to die, you don't give a shit. You're going to try whatever as a potential. And especially the youngins who are more into data are going to be more apt to do it, because if there's any kind of chance to save mom and dad, you're going to do it. So I think in the interim, all this nanotech and biotech stuff we're kind of hypothesizing about that hasn't taken on yet, that could potentially be the means of infection to change sentiment amongst the world. Because people who have no chance, something's better than nothing, and they'll try it. And they're generating data, which is going to give the big biotech or pharma companies feedback to develop new therapies. And then you can thereby new money, new income.
The biotech area is one of the areas where new tech will probably continue to bring improvements. And Wall Street has actually a massive investment in the, let's say, the future of the emerging genetic industry. How much that's built on number crunching and big data, I don't know. But that's one thing. Another thing is communications and space travel. You know, when you start looking closer at the World Economic Forum's technocratic dream, there is no question that they're relying upon added technology to enable it. So, like, yeah, but I remind that most of these things have a fragility in them which is unseen until afterwards. Let me just throw. Well, we talk about cycles in all of this, right? one of the, I tend to talk in terms of dominant cycles in the stock markets have a habit of being around around 6 to 7 years, about 10 and a half years, 8 years, about 10 and a half years, about 14 and a half years. A lot of the biggest cycles wrapped around those, and their doubles and their triples and their quadruples, which tend to match up with solar system orbiting periods. If you just look for the right places, you can see that these are kind of subtides of bigger tides or whatever, sub-wavelets of bigger wavelets. But the lengths of these cycles in the stock market tends to be coincidentally or happenstantially similar. So I want to talk about a 13-year cycle here now. That, think about 12.36, just you know that number I talk about. But if you take a 10 and a half year cycle and a 14-year cycle, around 12 years is in between. And then 12 years turns up a lot. Right? 1974 was a stock market low, 1987 was a stock market top and a low, 13 years between. 1987 was a top and a bottom, 2000 was a stock market top, 13 years in between. 2000 plus 13 years takes you to 2012 to 2013. Well, 2009 was the bottom. 2012, 2013 is one of a few consolidations on the way climbing out from that bottom, but not the bottom. However, if you consider 2012, 2013 as not being a sign that this thing doesn't exist anymore, then 13 years takes you to 2025. I'm just saying that 13-year period is a thing. I'm just dropping it in there that we remember that it exists. And I will update the 10 and a half and 14-year cycle work in the Tapatalk forum. Now, the in the Tapatalk forum, I also have, see, it's in the Newmont thread. Let's just, here, I'll show you my screen. It's easier to show the screen. Okay, to do it. Let's see, where are we? There we go. I do hope you can see that now. Why can't I see it? Is that visible now? Okay,
Yes.
so, all right, now I need to jump between two. So let's see. Okay. Hopefully you can still see that now. Now I can toggle between two things, and we should be able to see this. This is the thread in Numa in Tapatalk in the RNP Conversations Forum. General forums, stocks, miners, royalties, and streamers, Newmont. And last November, I was referring to trading group meeting number 42. We're at number 60 something now. In which case, I was pointing out the way the cyclical analysis works and its limitations. And I showed this chart here, which had 6 cycles with a 56% correlation with total movement of Newmont over 39 years from 1980 to 2021. Okay, so we just have a quick look at that. And you say, wow, that's an amazing correlation. If you could just work that green line forward, and then we'll trade the market and we'll all be wealthy. And my point is, it doesn't always work out like that. So the cycles in that were 4 weeks, 25 weeks, 60 weeks, 108 weeks, 576 and 723. Which, if you translate that from numbers, is 1 month, a half a year, 1 1/5 year. That's not a year. Okay. 4 years, 11 years, 13.9 years. That's our friend again. And then we know that we take that. And so what I did is I walked it forward. And when I walked it forward, it looked like this. Is that big enough, people? Hopefully you can see it. So Newmont had come up and was going sideways, and this thing was saying that Newmont would go up a little bit, and in June 2022, Newmont would go down, break down, do a rally in 2024, and be bottoming in 2026 and 2027. And then the next time back up would be 2033. That's what the cycle software was saying. All right, so this is last November. And I went on and I said, can I make that bigger? I said, now there's an obvious giant caveat with this. Cycle softwares are dumb calculators. And the limitations I spoke of in the trading group meeting, and this is the open meeting to everyone, so I want you to be aware of this. If you weren't in the trading group meeting, the limitations I said are that there's another matter specific to this stock and this chart. A breakout next year would invert the whole trading range forecast into a breakout heading upwards towards a 2026, 2027 top at prices significantly higher. That is saying that if this thing here came down and didn't make a lower high, if it went higher and took out the high back here, then the cycles might invert, and that might be an up wave, and this might also be an up wave. So this is something the cycle software can't do, inverting cycles when the market decides to invert. Anyway, so then I went on, what can charts do the cycle software can't? Now this is back in November 2021, okay? So I posted a chart. And in this case, I was showing a downswing and I was showing an upswing, which was a fractal swing. It was there for longer in this case than the downswing, not equal in time. And I was showing a cycle. Let me just take that out of the way. Hopefully you can see that there. Cycle which went from low to low and then went from low to the next low over here. And that, of course, suggested that there might be a rally, which the cycle software had said there would be. But this thing here was suggesting that there could be some sort of top there and it might have to deal with that and get through it or not get through it. And this thing basically said, essentially, you had to have a retest or a break. So the very first thing to happen after November last year was don't go lower. And the support was in this blue line here, basically wrapped around that low there and that low there. So the hypothesis was if Newmont stopped going down, it would open up the possibility of an inversionary swing upwards, which could be quite long in time. But in the short term, I was able to point out an inflection at or around November, a retest or a break, which had to trigger the next thing. February this year, there was a timeline. And let's just look at the timelines that were coming in prior to that. You had that, you had that, you had that, you had this thing break out here, and you had that thing proximate to the top. So February this year appeared to maybe be important. And was that February next year? February 2023. So how did that work out? And what would the forecast for Newmont be, given the fact that some of those triggers have been pulled or have not been pulled in the time since then? So here's Newmont. And we can see that in November last year, please disregard the overlapping moving averages. Okay, we can see that in November last year, yes, it did indeed stop going down. And therefore the next swing was a move in the opposite direction. And it did indeed break out. But did it break out relative to the previous large price swing? Well, the previous price swings are back there, and as you can see, that breakout is a new high. So that means the possibility of those cycles must be considered to be possibly operating on the upside instead of the downside. And the next thing to know about was the retest of the highs and what happened in February and what will happen in February next year if this thing happened to keep working. Well, let's see where February lay. Now I'm on weekly here, so I'm going to change it to daily, all right? So we're in daily now. And let's just bring a bit more data in so we can see. I want to get the old high visible here on the left. Okay, you can kind of see roughly where it's at. So the breakout is there. Instantly it broke out. It did a sharp pullback, but it kept going. And now it's doing a bigger pullback. This is a sharp move. This is another retest. So this is all a retest. But does that mean the trend has turned? Was this a false breakout to the upside or not? And do the cycles still matter? So there's the bigger picture. As you can see, there's the trading range that Newmont broke out of. Here's the breakout, that sharp up move there. Here's the red trading bar where volume came in to cap the rise and turn it down. And it actually kept going on a little bit of volume there, low volume here, and middling volume here. And the money came in heavy to drive it down again, because the red bars are where heavy money plays. Now the red bar can be big players trading, or it can be the public being routed and herded. You just got to admit that you don't know that. But the pullback is to similar levels as it was before, ever so slightly lower on one day. So what's exactly going on here? What do we have? Well, we have an inflection. We can characterize the inflection maybe by putting a trend line on there. And for the moment, putting a trend line on sort of somewhere like that. We make it nice and big so we can see it just for the purposes of this. And we can say we have a breakout inflection, but it didn't make a new high. It didn't gap up. I can't draw my inflection with a positive slope. So we have an overlapping semi-corrective inflection in the sense that the pullback took out the old high. Now that's a sign of a larger consolidation maybe being in progress. Okay, well, bearing in mind that this does not have an upward slope, that certainly does not mean the market, in this case Newmont, can't go higher. It's quite easy for it to go higher, but it might leave the opportunity for it to make, it has to beat its way through several descending trend lines. Like the trading range might be, let's just hypothesize here, trading range might be sort of between those two prices for the time being. It's in logs. Well, if I take log off, you get the idea anyway. It looks ugly because I just put that on while I was in log. So let me just take it off. So you have that internalized. Now the next thing was that I wanted you to note that February seemed to be important in this, and also the retention of the November low. Well, let's go back and check out November 2021. There's where the price was. What date was it that I wrote the post? Let me just remind myself. I did it on the 2nd of November, okay. So on the 2nd of November, I was writing that. Okay, so, here's the lows, and the 2nd of November is there, okay, down in this area. So I just put on my my cursor on the price when I made my post. There's the low of that day. And you can see that on the close of the year, they pipped through it for 2 sessions, both of which closed at their high. Well, the first one managed to look a bit bearish. And then a few days later, they did it again. Let's find out what date that was. Okay, that was on the 2nd of December and the 3rd of December. And this is on the 15th of December. I would characterize that as the end of year low. Remember, we're looking at Newmont. We're not looking at gold here. And then this, 2 weeks beforehand, low was slightly lower. And you notice that there's high volume on those trading sessions, which means there was big money sold it down, but big money bought. Anyway, the market went the other way, and then the next thing I had was I had a date quoted. Now in the cycle software, this may be running opposite now. All right, we're looking forward to something happening in June 2022, according to that. But this, February 2022 and February 2023, we're going to find the date of that in a minute. Okay, so we can look that up in a moment. So February 2022 would be, I had importance and I didn't write down the date, okay? I draw your attention to this upper chart. It actually has it on it. You see that there, that line there? That's the actual line I was showing you. And then on the daily chart, it was the 18th of February. So I had an inflection penciled in for the 18th of February. All right, so did the 18th of February. Now this is comparing charts with cycles on them to actual price charts using cyclical knowledge or interpretation, technical analysis in other words. So the 18th of Feb, I just line it up with that there, okay? But we can look at the lower chart and we can see that we were here. So that's not a breakout. What went on there? There's a little consolidation, but it's a few days after the 18th of February. My cursor has drifted back to the 17th, but it's there. You can actually see that it's the taking out of this gap over here. It's the attacking of this high for the second time. It's really a consolidation. I would say it's probably the construction of a mini inflection. Up, pull back, breakout, pull back, and it broke out that price. So it actually will, ideally, I'd describe it as having happened on the 17th of February. All right, well, we had it down as being something important. We're not quite sure. We seem to have found at the price when it got to it, seems to have performed a minor breakout prior to a more important breakout. And February 2023 is yet to appear on this. So, and the 6th, June 2022 would be somewhere around here. So you can actually just, it's going to be resolution of this thing here, this pullback. It's going to be resolution. But there is this price down here, which might be a hard line in the sand. And the price of Newmont has been slipping somewhat. Anyway, now let's go up and see how important were those trend lines looking, or those timelines, I should say. Because we didn't have a little crystal ball at the time. Well, the previous one was a little bit early, but it was proximate to the breakout. See there? It was it wasn't the day of it, but bearing in mind that this is calculated long in advance, I think you would say it was early, and it probably is either the breakout it's calling or it's the top it's calling. It's an inflection of sorts, and maybe adding about 5 days. I think on the weekly chart it probably would have looked very exact. If this was switched a little bit over about to the right, you go, the closer to this inflection here, up, pull back, breakout, pull back. There's the breakout there, and the price has retraced to that level. Well, if that's the case, the line in the sand is here and now, but it's below the old high. So if you shifted that a bit to the right and shifted this a bit to the right, that's what you'd be looking at. This is an inflection. Why is it on low volume? And no. So anyway, this is trying to figure out support and resistance. How are the other timelines looking on this? Oh, I had something, I typed in something there. It just only reappeared. High or low, important pivot, whichever. I didn't know what it was going to be. Yeah, it was a low. I probably did that during some meeting. Anyway, so the next timeline was 30.9, which is 31 minus a bit, which was that inflection. Well, it didn't get back to there over here, but I think it's clear that that's the inflection that was getting retraced once, twice, 3 times. Hit it hard there, didn't get to it so well there, didn't get to it so well there, but did a really hard try on volume there. Which is why I would pull my support line up from where my cursor is, and you'll notice that that's precisely where I drew the arrow in blue. But fading, that getting so low and that getting so low, in particular that day there, I took it up from there to there, from there to there. I want to go back a little bit further and see where those timelines working out in that thing. Well, you know, what's that? Kind of before a cascade, yeah. Would it have saved your money? Would it have made your money? I doubt it. This one here cut the low, secondary low pretty well. This one here, some sort of bottomy breakout thing, and this one here pretty much on that top. So they do seem to be, by the way, they're going up in 16ths, I think it is, of the cycle. So it may have slipped a bit, and maybe we should shift them slightly to the right, or maybe we leave them where they are and we make allowances. Support may be where this new mont is at, or support may be down here. But there's another type of support which used to be down there, which maybe it should be raised to around here, maybe. Anyway, that's how that forecast, if you like to call it a forecast, worked out. And you know, the limitations and the advantages of these techniques. But you do see how the cycle software has great limitations. It seems to provide the super answer, but it's really, the cycle software is more or less just for sort of, it's like casting a giant net out in the ocean with big holes in it. But if there's any whales going by, it'll catch one and you kind of go, oh, there's something in there. But if you want to find out what's in there, really, you need to put in something a bit finer mesh. And you need to have to see the signs. And a combination of technical analysis, support and resistance. Now there was another thing that on that chart there, I had the, you notice that I had that fractal and it ended just before the green line. And it was essentially, there might have been a question there, kind of like if that's a low and this is a low, if this ends up looking like a high, then if this fractal is up there, it might turn down. It's not quite, I wasn't making that point because proposed possible high was very close to the green timeline of February. I'd say probably January. So let's just clear up that little point. And here's our February timeline, and our January period would have been around here. Oh, there it is. That there is the fractal move. So the fractal up move, let's just zoom back and say kind of like how did it look in the market? It made a low there and it was causing rising market. And it kind of like was saying somewhere when you get to around this date, you want to watch out that things don't come to an end. And they paused. They did pause. They stopped and they tried to come to an end. And then they said, no. So you can actually see a beautiful example of a fractal. Actually, you can actually see it operating there. You can see the selling coming in. Whammo, 3 days of, it just got unloaded by somebody, whoever the fractal is tracking or whoever's footprints those are, whatever entity they are. But you can see the market kind of was bouncing. Suddenly it wasn't bouncing again. And then it kind of, okay, we've swallowed the extra supply which manifested. Now let's move on. By the way, that means that fractal may be a goner, but it may also be running. It may have doubled in length. It may be running this smaller cycle that was down there, but inverted to the upside. And it's just got to be pay attention to what's going on. Now, let's look at one other thing, which is part of this analysis had been that there's this cycle low from there to there. And if it replicated, it would come in here, and it did. But we're past that date now, aren't we? So we kind of really should be looking at how do we know if that cycle's gone away or if it's still around? Well, there's a whole bunch of how can we be sure? Well, one way to help us be sure might be to just put on a little display for ourselves. Next time we're looking at this, we'll see it. I'll take a note of the dates and whatnot. And say, well, if it's still there might be a low out here, or maybe it'll be a high if it inverts. And isn't it curious that the top of that cycle falls upon the 50% ratio of this giant wave? That's the February 2023 date. So if this cycle did make a low here, and if this is a mid-cycle pullback, and if it contains itself, then it might make a run, which would take it up to about this area, and then you start watching for the next consolidation. Or the next downswing, which could invert and could become an upswing or whatever. You start looking at support and resistance in the days following that date. But that's 9 months away. So I think we have our attempt at sort of trying to figure out what you might be capable of going forward. And one of the things would be it's dealing with this old high, seeing if it can stay above it. It's getting cyclical support from this low, which might last out as far as February next year. That doesn't mean there can't be contra moves. And just how big is that? How big is this trend line here? See it? How big and important is that to Newmont? Oh, I've now got, I've gone back to 1992 here. $1987. Is it? No, 1980. Yeah, that's the 1987 crash there in Newmont. Now we're in logarithmic here, okay? It's daily, so it's a dense bar chart. And you can see that I'm fractionating this possible move of that low here. You can actually see that. So I'm fractionating that, and I'm hoping it can continue to work in roughly equal segments, which it may or may not do. Is that an important trend line from 1987? Through to now or farther? what's that, 35 years? My trend line goes back farther than that. Does it actually have another point of contact even back? I mean, I don't know. I don't have data. Look, in the circumstance, you know, when you have something like this, you should say to yourself, well, the entire world is looking at this. If it's going to go down, it's probably not going to go down with poking its head through first. It did that. If it's going to go up, well, if it gets up and stays up, then this is going to be truly hard support underneath. Let's take log off so we can just see what that would look like. And then you go, oh, if it's going to go up, well, if it can get through here, which it did, it's under currently, then it could be a massive acceleration point. And you have an upward sloping support level with that level of rise on it. Whoa, that would be something. Has it happened before? Well, the answer I would say is, if you notice, there's a trading range lasting from 1987 through to 1990. So there's a decade, and the market was very corrective. And Newmont still managed to stay above that trend line, which was violated here, retraced, and it traded all over it here to try and kind of go, no, that trend line doesn't work. No, no, it doesn't work, doesn't work, doesn't work. It just got obliterated in an incredibly methodical way, which makes me think it does work. And there's your breakout, and there's your pullback to it. So where's the trading range? Is the trading range what we're looking at? Well, yeah, we're in it. But if it gets above that again, then life might be all hunky-dory and wonderful and rainbows and unicorns, because you would then have a trading range somewhere up there for Newmont to play around in as it goes into the future. Except that right now, it's below that. So it is where it is. As long as it's below that, you start to look for all these targets, you look for all these possible support levels. And this is one here. And there's a little one there. And the next one above has already been hit. So this is the playground. But if this is an up move, yeah, kind of if it's an up move, the odds are the 50% line is going to be a high rather than a low. But like, it is what it chooses to be. So I do hope that takes the old Newmont, which is pretty much suitable proxy for most large gold stocks, and walks it forward quite a bit. I think I'll just stop there. That's a very optimistic place to leave that trend line up there, isn't it? I'll leave it on it. It's very bullish to have that even on the chart. These ones here, these are more like, where is that? By the way, a technical technique might be to say, if this is a trend, if this is a range here, then that one there should be the exact amount higher than this range is. So I'm going to do that, okay? So let's just do a little retracement thingy here, okay? And we pick any date. Well, that date there will do fine. And we're going to put the 50% on the, there, see 50% there? Well, that means that this guy here, I didn't put it high enough, it should be there. So now the two trading ranges would be equal, okay? Well, here's the interesting thing about that. How far into this range did it get? So we're going to look at that now, okay? So let's just go properties, and we'll investigate. What would a 50%, 50%, there's 0, there's 50, there's 100. So we need 50% of each sub-range. So So I need a 25 and a 75. So we'll make that a 25. And we'll pull up a 75, there's 76, 75. And that's going to show us where the halfway points within the sub-trading ranges are. And here we go. So did it get, okay, now remember that this is as of that date. But as of this date, did it get halfway up the next range, which it has rejected and pulled back out of? So in order to do that, I need to take the whole thing, right? Let's see, here we go, move it back to the date of this high here, okay? And as of the date of that high, I need to, I say, oh, that's interesting. I mean, you can see I didn't lay it out perfectly, it's just a slight difference. But you can say, yeah, the price got from here to here, it got halfway. And it used to move this much up and this much down. So if it moves the same amount, but if it were to start at the halfway point and go down for that amount, might it stop falling at the halfway point of the previous range? Because the halfway point of the previous range is there. I'm kind of putting it on sort of parallel. Is that about right? You good with that? It's kind of, I'm just laying it on the halfway. So if you start from there and you go, I'm going down the full length of this trading range, now you have to allow time for it to happen. But you might go, maybe, just maybe, it'll stop going down when it gets to that. Just possibly. So anyway, it's a food for thought and probably a best shot. This crash move back is a typical breakout pullback. Short-term version, bigger version. What you don't want to see is it keep going down. What you do want to see is a short-term support and break above that line there. Get a little finger hold, get up there, another little finger hold and go again. I'm inclined to say the trading range for Newmont is sort of maybe between the green lines. Maybe. But if it weren't to get down to this one down here, if it were to get a purchase there, say, then you'd have to say to yourself, oh, wait a second, from there to there, you add it from there to there, and you go, oh, my new trading range is between that level and this level. So anyway, what I'm doing is I'm going fishing, I'm casting into the sea, my little bait, and I'm hoping that the fish that bites it will have the words and the new trading range written on its side. And when I flip that fish over, I'll see lovely numbers. Anyway, there you go. I think Newmont is pretty much a good proxy for most large capital gold stocks. So let's do Elliott Wave 1, A, B, C, 2, 1, 2, 1, 2, 3, 4, 3, 4, 5. Oh dear, that does look terrible, but is 5 over? Is that just wave 1 of wave 5? And this is wave 2 of wave 5. And wave 3 of wave 5 will go out of the upper side of the chart. Well, Elliott Wave doesn't give us that answer, but the general tendency of gold and silver is to make spiky, extended final moves. I just want you to look back through past history in Newmont and say, do the final moves look very vertical? Well, in 1986, yes. In 1996, yeah, it was a big spiky move up, but then it stopped. The next move up got to new high ground in 2007, 2008, whatever. It was a little bit logarithmic, but not very, not you know, it wasn't like 1986. And then over here, it had another new high. A little bit, you know, underwhelming. Back again. New high, underwhelming. And then we just got to find out what this thing is, don't we? So, yeah, the days of the big spike where you could be counting your winnings and sort of saying, I'm never going to sell. It'll never come down. Oh, yes, it did. But those days are in the past. 1986, what's that? 13 years to 2000, 13 years to 2013, another 13 years to nowish. That's a 38.2 years. Anyway, just casting it in terms of, let's say, the esoteric cycle numbers. So it is what it is. Support and resistance decides. Okay, so I'm afraid I can't see the chat while we're doing that. I have to overlay the chat screen, so Lance is gone. Yeah, well, you catch that. So look, that's what I got for you. There is another thing possibly going on in silver dollar, silver and US dollar. Let's just remind ourselves of how it looked in the Swissy. There was this wonderful trading range going on for a couple of years. Let's make it weekly and just take the bigger picture. And you can see in the Swissy, there's your 2012 high. Down it came, made a big spike low. Everywhere else, the low was over here, but in Swissy, it was here.
Oh, we don't see your screen right now.
Well, you can't see my screen. Oh, right.
Or at least I don't.
No, I think it's, yeah, it didn't take. Excuse me. Let me, I know what's going on here. Canceling and resharing. And 3, 2, 1. You got it?
Yes, there it is.
Great. So it's the Swissy. Let me just zoom it back a little bit so you can actually see. There's the 2011 top. Here's 2012. Down you come. All the other markets make a low here, but in the Swissy, it's here. And the Swiss bank, the Swiss Bank Corp, they've been printing cash just like the best of them and trying to buy something with their cash that would go up before the cash itself went down. And this seems to be one of the things they were doing because low, and then a big shakeout. And the interesting thing is from there to there end time is the same as from there to there end time, guys. See, there's a rhythm going on in this thing which we should never, ever forget exists. So if you go halfway from there to there, where do you land? You end up here. That's a breakdown of a rising triangle. Horizontal top, rising bottom, boom, broken down out of it. Instead of becoming a super bullish pattern, it becomes a trading range. Well, you know, if the most bearish thing they can make is a trading range, I think that's bullish. Now let's go back to daily. And in the daily view, here we go. Here's our trading range. Here's the breakdown. Well, we really need to know when the next end of that cycle is. Here it is there. The end of this year, guys. Now, if this thing breaks out, fine. But I tell you, if this thing is going to make a low and it makes a low there, and if it happens to be down around here in November, you know, if it continues down, you'd have to unload a position. But that might be as good as it gets for adding. However, that's it against the Swissy. Let's take these lessons and see if we can apply them to the dollar. What is the amount of time we should be thinking of? Well, basis daily. We probably should be thinking of a cycle of, well, let me just make that weekly just so I can count easier. Okay. So basis a weekly chart. When we switch over to the US dollar, we should be saying, now I need to be looking at that's 2,427 through to 2,567. So that's 140 weeks. What on earth is 140 weeks long? Kind of curious. And 140 divided by 52. 2.69 years. It's a little bit longer than the 5.25 year cycle, guys. Okay, 10.5 years solar super cycle. Split at 5.25. It's kind of just a little bit over that. All right, so jumping from there to the same thing in the US dollar, we're going to find a more complex chart, always. So here we go, here's 2012, and down it comes, and down it comes, and you can see that this low here is not the lowest low, such as it is in the Swissy. You had to wait until here in December 2015. Just there. And then up it went, and it came back, and it did a double bottom, or a higher low, whichever way I like to call it. Then it took out everyone's stops, and off he went. Well, let's just look at what happened there. Let's just consider this, technically speaking, there's a false break to the downside. That's bullish. Followed by a breakout at the other side of the trading range. That's bullish. Followed by loads of not bullish movement. Going sideways. Is it going sideways above or below support? There's a support there. Here we go here. Well, it's above support. Ain't that interesting? But the bulls are being frustrated because it's not going up. So, looks like it's heading down fast lately. We do seem to have a few timelines and a few trading ranges and angles going on here. So I think I have to take the log off to make those trend lines look pretty, and all of a sudden they're parallel. Let's take a standoff view and say, what's with the trading ranges? And you go, okay, so I got this big range here, kind of from the secondary high to the rally top, and I'm fractionating another trading range. Excuse me. And if support is coming off this pivot, his might stop there. And if support is coming off this pivot over here, I need to drag that down a little bit, because that might be where it tries to get to throw everyone overboard. And it's all based around this this retracement. So actually I've already done here what I just did on the other chart. But this is over a longer period. So something in the end of this year. Well, let's just put my cursor in June. May, June, about there. And we can find that in June, some years you get a rally and it turns down for the second half of the year. Other times you get a rally and it sort of goes a bit sideways and then turns down at the end of the year. That's December around there. So not quite the gold cycle. Not quite January to December. It's more like kind of January or February through to July through to next January. It's a little bit like the gold cycle, slightly late. And are the timelines doing anything positive? The answer is, I don't know. Okay, my displaced moving averages are no longer synchronized with the market. We are looking at the timelines. I'm going to turn, don't know, peak, don't know what that is, peak and a collapse, an attempt at calling a bottom. Well, the answer is a whole bunch of don't know for that. And then there's a cycle there, which is going from a high through a low to a breakout, which is bullish. And then it turns the other way and it goes round, but it actually makes a top on that date. So maybe that should be upside down as well. Which then creates a cycle from there to there of twice the length. Okay. So anyway, from there to there to there is 1.5. 1 plus a half. So that has created a cycle from there to there. Just came into creation then. Didn't exist before. So then we go, okay, if we take that top there, and so I'll zoom in so you can see a bit better. This is against the dollar, of course, right? So here we go, that's the peak. So do we flip it upside down? No, we find it's a downswing this time from high to low. But we now know that there's a 1.5. So there's 1, here's the half, and is it that top or is it the second low or is it between these two lows? All I can say is it could be that there's a price swing from there down to about here on somebody's fractal chart somewhere. Whoever would have it, I don't know. Oh, that would be me. But if that's the case, then it didn't go down. It didn't break. The 1.5 cycle bottomed. Right, let's go back to the 1 cycle. There, to there, to here, to here. What do we call that? Is it that low? I don't know. Questionable. And then we looked at the Swissy, and the Swissy was saying, well, not quite like Julius Caesar, beware the Ides of March. It was sort of saying, watch the end of the year. So how is silver looking? Treading water. It did a major breakdown before it broke out. It looks more like wearing everyone out before it takes off again. But it's more likely to take off again from price ever so slightly below this trending range. This gap here. Which is probably why I have that green trend line on there. Looks like I have another one above it, which is clear. Let me pick it up. No, I can't. Anyway, so look, I'll leave it with you. There's the scenarios on this are a little bit unfriendly. Let's see. We should be catching in the more this here looks like a Neko up back there. Pulled down, double bottom before it went off. Okay, well in this case it's pulling up, double top, and inversion. Well, it might be saying that after the 11th of May, and remember if this thing were going up here and going down, that's May as well. So in the very month of May, this thing here is going to be exploring one side of its trading range and then deciding if it wants to be in or out. And at the moment, it looks like it wants to explore the lower side of the trading range. In silver, I would normally run from May through to about July, end of June to the middle of July. And then I'd say, where's the July low, or where's the June-July low? Oh, it's compared with January, it's higher, it's lower. And then secondarily, I'd be looking for the mid-quarterly tops and go, is it making higher highs in between these periods? And then I'd run my mind through to end of Q3 and end of year. But with silver, I'd be kind to say, no, that was for gold, end of year, maybe end of year plus a bit. Where does end of year exist with relation to these two lines? Well, December, the middle of December would be about where my timeline is. You can actually see, you know, in one case it's a breakdown point, in the other case it's second bottom. Two different scenarios, but it tends to be setting direction. What's this? This is a breakdown. What's this? This is a double bottom. No, we're not breaking down. Look at that. Let's prove it. Boom, boom. Go the other way. When did that happen last? Well, that happened last over there. Where was December in that case? That's sort of around that low there. So the lowest low was in these three little lows. End of year was there. I think I actually had it called. I think I was calling the end of the year for silver buying point. Well, we're back at it again. Ain't that interesting? Where did July land? Last July, 2022, end of June, about there. There's the middle of June. That's the gold contracts being arbed into silver. Then it goes sideways for 4 weeks. You can't make this it up. And then you get to the silver delivery month, which is the end of July. And they clear it out, and the uptrend line gets taken out. There it is. Boom, boom, boom. And it's to July. So when they ran the punters out of the market at the end of the July delivery month, they got it below. Let's just say, let's put it like this: not enough people stood for the delivery, and the trading range went from above my cursor to below my cursor for the following 12 months. So that's why I say I tend to watch silver carefully in July, but it's really kind of like middle of June to third week in July. Oh, that's not telling you what it's going to do. That's telling you how it's going to tell me what it's going to do. As I say, there's a lovely trend line coming up underneath. You know, I'm not persuaded that this could be a top here. This could be a wave one, a wave two, a wave one, some sort of big extended wave two. But what's going to happen if it's going down is it's going to make new lows. And if it gets above those new lows, after trying to make them, then it's going the other way. And when would we be paying attention to? Well, we kind of know when. This here does seem to be running inverted at the moment. If it's running inverted, then silver is doing the opposite of what it's doing there, where it's going up to there. Now it's going down to that point. And that is what we're at inverted. And notice that that's the top of the trading range. And this time it's coming down to the bottom of the trading range. So we're running a reverse pattern of the first half of the trading range. Interesting. Also chaotic looking, also hard to decipher There are a few support lines that I put in here. There's one there. I don't like that it's below it. It's bearish when it's below it. Next one I have in this is, let's just pull back so we can see. I didn't put any more on, but you want to see where they come from? That's where they come from. From here down to here, over there. By the way, for silver traders, I'm going to go myself as well in a minute. For silver traders, be aware that we were talking about a low in the Swissy here, and everyone else's low is here in gold, December 2015. But for silver traders, the high is in 2011, and the low is in 2020. So silver had a 9-year bear. And it's above the bottoming formation of the bear. Well, if it was a 9-year bear, you're sort of saying, well, how many years am I going to go up? 9 years up? That'd be great. Say it only goes half that. Say it only lasts half of that. Well, 4.5 years up. That'd be for half of 9 years. It went down for 9 years. Like, reasonable to ask for 4.5 up, isn't it? When do we start counting? 2020. Oh yeah, election year. That's interesting. So what about 2024? Oh, yes, indeed. So it's early days. Little bit at a time. So I'm still in buy the dips mode, I think. But I need it lower than it is and turning up, I think. And that's my best shot at silver for now. Right, so okay, nothing in the chat. So let's stop sharing the charts and we kick it over to conversation.
Yeah, I must say I'm patiently waiting as well, hoping for a good buying opportunity in the metals. Yeah, I mean, like I think basically in everything. So like right now, to me, it feels as if cash is king, or the dollar at least.
Yeah.
And we just have to wait for opportunity to show up.
Well, maybe we'll get something good in silver. I mean, something bad for silver that gives us a good opportunity at the end of the year. Maybe. There is the possibility that the July pivot will provide something. Just possibly. July last year, pivot was an interim bottom. It was a low before the low. So we'll see. It's not that long away. In the meantime, just watch out for the fact that May can be a turn which sets up the next price swing, which leads you towards July pivot. So in the next 4 weeks or so, we should see some sort of consolidation and pattern forming. And then it should come out of that and head towards the mid-year pivot. And just whatever it does, we'll try and make sense of it. If that's a flag, that's a very, very long horizontal flag. It's getting on 2 years old now. About 1.5 years anyway.
Yeah. Personally, I must say it looks a bit like a head and shoulder top to me, but
well, it can be. Yeah, I mean, it can be sort of a head and shoulders. If you characterize it as a top, I'd say I think I see two big dips from some neckline or whatever. But it is what it is. We'll see.
Yeah, I mean, if it head and shoulders hits, I mean, it would just be a retest of the low. I mean, the target would be around. Let me see here. Yeah, $12.55 is a target I have. at
You
my
reckon
chart.
for 100% pullback?
Yeah.
Well, that'd be the pullback. That'd be quite the pullback. Yeah, Fed would have to do something good for that. Do you know what? The central banks are incentivized to crash the stock market at the moment, despite the fact that they own tons of stocks. And they have the weapon to do it with? Well, they can rise interest rates. Can they crash stock markets without rising interest rates? Absolutely. They got portfolios of stocks such as the planet has never seen in its history, because they've been buying stocks with all that money they printed for the last 10 or 20 years. So no problem to them. They have controlling interests in so many things. They are the whale. So what's the support and resistance? Okay, are we... Keith, you had put in a few ideas into the chat there. Do you want to have a word? Keith is... We've lost him. Okay.
Keith gone. Yeah.
Yeah. Okay, how about you guys? John Sudi, Kerry, anything? Otherwise, we wind it up now. Okay, let's end the recording here.